Good afternoon, everyone. Thanks for joining us. This is another Convergence event. This one's about automated trading. The purpose is going to be covered here with the agenda in a minute. Let's start. First off, you need to know that derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. The opinions shared here by us or by the panelists are their own. What are we looking to achieve in today's webinar? We're going to push through a lot of material. It's another session where you're going to feel like you're drinking out of a fire hose. We know that several sources have indicated that the majority of the volume going through the exchanges these days is done through algos. We're looking to explore what is involved with creating an automated strategy. So we're bringing on two panelists. These panelists are these two panelists have managed to go through the process and have built a fully autonomous algorithmic strategy and have deployed it in a fund. This gives us rare access into the process of transitioning from trading manually to having a strategy automatically trading for us. Just a brief comment. We will be taking questions at the end, so just save them till then. Like I said, we have a lot of material to cover, so we want to push through it, and then we have a little bit of time to take 5 or so questions. What will we cover? We'll get a brief background on Adam and Chris, who are the panelists, the experts here, and we'll go over their history. We will learn about what brought them to where they are now. We will go over their strategy and how it was created, what obstacles did they encounter, and how did they deal with them, and many more questions. Anthony, who's the managing partner of Stage 5, has an interesting offering to share with you here during the presentation. We'll get to that. And Adam and Chris will take questions for about 15 minutes on the end, assuming we don't run over with our time. We will hopefully wrap up by 6 p.m. Eastern, and of course, if you're registered or if you notify us, you will receive a copy of the recording. Who are the panelists? Let's bring them on. So let's make sure that these guys can hear us. Adam, Chris, can you hear me?
Hi there. Loud and clear.
Okay. So, Adam, I just want to ask you briefly to introduce yourself. We just want to establish who you are, what roles you play in the strategy's day-to-day operation, and can you tell us what you do for Red Ivy?
Yeah, sure. Thanks for having us on today. I think if I give you a bit of background about where I came from, it might make it a little easier. I started out as a market maker back in the late 90s in London, small and mid-cap stocks. It was a time when we were transitioning from the phones to the screen-based trading, so it was kind of an interesting period. It was a great way to learn how the short-term supply and demand worked in a market. I did that for a while, for a number of years, made plenty of mistakes, learned a lot about how stocks moved, how markets moved. I then moved to a number of other European institutions trading and running prop books, and then started for a fairly large US hedge fund in 2006, starting their London office. And then moved to New York with the same fund in 2008, hence why I'm here now.
And you're currently in Connecticut, right?
Yeah, we're in Connecticut. We've been here for a couple of years now. Started the firm in 2013. After I got to New York, I was with them for a number of years. I mean, I think during the period at that hedge fund trading, equities, futures, and options, probably tried pretty much every sort of, I guess, technical indicator on Bloomberg over the years. Everything from the basic, RSIs and moving averages, and all the way to trying out sort of Elliott wave and DeMark. And I think kind of knew what I was looking for to sort of aid short-term trading. And I think this is where the systems trading came in later. It was all sort of part of a build-up, and it pointed me towards that direction. And so after using fundamental and technical indicators. I moved much more to the technical side, and moved from that firm to a proprietary family office that was very heavy on technology, where we had access to building out our own strategies and scanners and automated strategies. And I think that was from there where a colleague and myself decided to start Red Ivy and sort of kick off the road to automation and systems trading. We launched Red Ivy in 2013. The group currently manages over $30 million in equities and futures. I feel even though we're sort of relatively small, the products we're developing are pretty much at the forefront of the systems world. We've got a great team, some really great minds, and even though there's a long way to go and we have a plethora of ideas in the pipeline, it's kind of really just the beginning. And so at Red Ivy, I control really the business itself, develop the signals mainly with Chris, and I develop the signals in conjunction. And so along with the day-to-day running, it's the risk, and it's really a very collaborative team where we all take on lots of roles, and it's a very flat structure, and everyone's involved pretty much with everything.
Okay, let's bring Chris on here. Chris, I understand you have a background as a principal at Microsoft. Can you tell us a little bit about that and give us a little bit of background on your trading?
Yeah, sure. Hey, thanks for having us on, Maura. I'd appreciate it. Right, so I spent 13 years at Microsoft, and Microsoft is a company that most people think of as this, huge Borg of a company. But really the most interesting work done at Microsoft is done in a bunch of very small sort of startup teams that take funding and incubate new product ideas from within the company. And so I worked on a lot of different and interesting projects along those lines. Most of them were well before their time, but included some high-scale, web-based applications and things like that. And obviously I've taken a little bit of a different path to the financial markets than Adam. But I really have been involved in the markets for quite some time. I was a pretty active swing trader probably from the late 90s until I became more of an intraday trader probably around 2007. And sort of working on the West Coast is great because, you could trade the market open 6:30 in the morning and for a few hours, head to work, and then trade the close over lunch. It was kind of a fun time and interesting way to trade the markets. But I finally left the company in 2010 to basically trade my own accounts full time. And after a couple years, I realized that my passion was really at the intersection of, where technology and the financial markets intersect. And at that time, I sort of switched my focus from discretionary intraday trading to building out automated strategies.
So you're essentially a good representation of what happens to most listeners here. You started out as a trader, both of you, and then you decide to go the systematic way, which as I understand it, is a pretty difficult transition to kind of give up that control to a system. So we'll not a system but a strategy. So we'll if you had anything else, you can go ahead, but if not, then I know we have a whole bunch of questions. We're going to grill you guys, and I want to get to those. I'm kind of aching to get to those.
Yeah, just real quick, let me just finish by saying that finally in 2013, Adam, Jeff Davis, which is a friend of ours, and a few others really joined forces and built out this full trading platform and a bunch of signals for Red Ivy, and that's kind of where we are today. Great,
very cool. Okay, so let's talk a minute about your CTA. I know you're running a fund, a hedge fund, a FINRA-based regulated hedge fund, and that's where you've been taking most of your signals over the last few years. And then you got into the futures space with a CTA. a commodity trading advisory, and you went live in November 2015. I just wanted to make sure for those people who are interested, since you're here and spending your afternoon with us, that they knew that this is what you do. The CTA is QEP investors only. For those who don't know, that means you're a high net worth investor, and the CTA is active, currently trading the signals that these gentlemen are going to cover here today. Let's go through the process of creating your strategy. So the baseline is, we wanted to create a baseline for terminology just to keep everyone on the same page with in terms of what words you're using and how you're using them. An input is what goes into creating a signal, and a signal is a well-defined setup, or is something that is a combination of inputs. Correct? Is that how you're defining it?
Yes.
And a strategy is a collection of signals. And you don't like to use the word system or program because it has way too many meanings and contexts. So we'll be using the term strategy to describe what the program is doing. So I just wanted to make sure we get our terms straight here. How did you get the ideas behind your strategy?
I think if we go back to the beginning, Chris already mentioned him, a great friend of ours, Jeff Davis, introduced us to a tape reading tool he devised for discretionary trading of equities. And for me, I've looked at a lot of indicators and systems, etc. over the years, and it was just something that really caught my eye, and there was something sort of there that we could do more with. So I think after watching it for a number of months, it was clear there was some additional value that we could probably unlock. Took a fair few attempts, and a lot of messing around and going nowhere. But we finally kind of enhanced the tool to a state where we could apply it to the S&P 500. Once we got to that stage, we had to build a signal generator in order to really process, to execute our processed data. And then around that, we built a number of automated signals and started trading the ES based on the underlying stocks within. During that time,
okay, go ahead.
So I was going to say, during that time, given the complexity of the tool we had and the signal generator, we had to build out our own backtesting system in order to get to the next stage, and we also built out an execution system. Obviously this system is pretty different from what a lot of people are doing. It doesn't involve price patterns, your standard indicators, your RSIs, your MACDs, etc. So I guess in essence, in short, what we do is we're scanning the market in real time for buying and selling pressure, and then using that data to trade various index futures such as the DAX, the Mini, and the Nikkei.
Okay, very cool. I think you guys covered this a little bit. What compelled you to trade algorithmically? Could you be doing what you're doing manually? Could you be looking at this scanner that is underlying the system and executing it manually?
Chris, do you want to take this one?
Yeah, I could take this. I think if you've been trading for a while, you've seen some changes in the market structure, especially on the lower time frames, intraday. That time frame has become much more difficult to trade over time. At least that's been my experience. And it just made sense that a more mechanical approach that was, didn't have any discipline issues, didn't have any emotions getting in the way, would be potentially a better approach. And I will say early on we did attempt to sort of gray box our signals, which means taking the computer-generated signal and then manually entering an order for a set of whatever stocks or indexes. But our signals even though they're not high-frequency signals, there's still too much latency on the intraday time frame where scalping some of these signals was very difficult. An execution lag of 30 seconds while you take a signal off a web page and punch it into your execution platform, can actually make your entry so much worse that you lose the trade. So one of the key insights I think we had from that experience was it just had to be automated, at least on this time frame and these types of signals.
Okay. Very cool. What inputs is your strategy built on? I think Adam covered that a little bit. You went over the fact that you're scanning the market and looking for buying and selling pressure. Is there anything further you wanted to add to that?
I would say, yeah, Adam covered it pretty well. We're trading the indexes based on underlying stock buying and selling pressure in a couple different markets. We've got a bunch of signals that they sort of model different behaviors in the market. So there's some trend, some mean reversion, long and short, and it's all really based on our proprietary data.
Okay.
Yeah.
Okay.
One thing I would say is we don't use any price patterns or anything. A lot of people are looking for patterns, price patterns just based on candlesticks or combinations of bars or whatever. We don't do any of that. All of our stuff is based on a sort of a different view than I think most people are looking.
Essentially real-time market-generated data as opposed to looking back.
Correct.
Would you call it a mean reversion or trend-following strategy in nature?
I would call it both. The strategy includes signals that have both characteristics. But because we're intraday traders, a trend, it might be laughable to have like a 30-minute trend, but they do happen, and a trend for us could be anywhere from a half hour to maybe up to 4 hours, something like that.
Wow. Okay.
But we also have some mean reversion signals as well, so it's a well-rounded strategy, I would say.
Okay, since you're fully systematic, and that means signal generation, execution, trade management, and exit, what order types do you enter and exit the market with, and why? Yeah,
this is pretty basic for us. We enter positions using market orders. When we know we want to be in a position, we get in and we pay the spread and we go with it. Once we're in the position, generally speaking, we have quote unquote brackets that are orders sitting at the exchange, for profit targets and for stops. For most of our exits, there are times when our signals determine that the probabilities of a successful exit have changed, and they'll move exits around, or they might exit immediately through a market order.
Okay.
So you've got something here about icebergs.
Icebergs. You said you just pay the spread and just go. So you're basically
right.
Making market orders to enter and exit the strategy, right?
Right. Yeah. We don't use icebergs today. I think at some point, at a certain size, icebergs may make sense for some of our execution. But I'm not sure if people are aware, but there are some changes that are happening over at the CME later this year with their new full book data feed that are going to change how icebergs work. And so it'll be interesting to see how that all plays out. There's not a lot of information about it right now, but I think at that point, if we need the capability that icebergs provide, we'll probably have to look for some alternatives.
Is that the MDP3 or something like that?
It's the MBO.
Okay.
Yeah.
And then, so you answered the second question as well. There may be a situation with the way that exchange handles orders that may cause you to have to go to like some sort of a smart algo to get in and out of the market.
I would say, we've already thought a lot about this and how we would approach it. We have a trading platform and a bunch of different connections to different brokers for execution. And so, this is one of the things when you've got a an algo that trades this stuff, and you've got to be aware of what's happening at the different exchanges and how the rules are changing. And you've also got to have a sort of, you've got to look ahead to start to think about how would I handle this when this happens. And so we've already got ideas about how we will do our execution at, as our size grows over time.
Okay. So let's talk about risk management for a second. How are you managing risk? You're sending you're creating the signal using the underlying equities. You are putting a market order out there to pay the tick, pay the spread, and just get in. And then do you immediately put on a stop automatically? Is that what you're doing?
Yeah, I mean, I'll tell you something. I mean, I think if you we always put the stops on automatically when we generate a trade. I mean, if you look at how we're managing risk overall, it's definitely the most important thing we do. We have a number of, not only do we just put the stops on, that's fairly arbitrary that a short-term trading strategy would have an automated stop, but we break the risk management down really into different parts. So we have like some known risks, which we classify, might be trying to avoid trading during the 10 o'clock news hour, which we don't, because we don't want to be exposed to, market moving economic releases that are going to really where we're going to have no edge at all. And another example of like a known risk would be like a Fed day. We don't trade around Fed announcements, given the volatility. I mean, these guys are just somebody has some great algos that are just running the stops up and down as the announcement comes out, and we have no edge at that point. So why should we? There's no point in us trading.
So, so is that? Do you manually just turn off the system, disable further signals until that news event clears, like today's FOMC? You just shut it off before 2 o'clock Eastern and then turn it back on at some point?
No, it's all pre-programmed. We have to obviously enter the dates, but other than that, the system is programmed to shut off at a certain time and turn back on at a certain time. It's fully automated.
Okay. Are there circumstances where you don't have a stop on your strategy?
No, we always have a stop. Sometimes it's a fixed stop. Sometimes it's a trailing stop in another example.
But,
we always have a stop.
You always have a stop. Okay.
Always.
You told us how you're handling economic releases. Are there time restrictions on the signals outside of economic releases?
Yeah. So obviously it's an intraday system. If we're still in a position towards the end of the day, we have a cutoff time when we will exit trades that we're in.
Okay. How closely do you monitor the strategy? Even though it's fully automated, it's running on its own, it's a robot. How closely do you have to watch the strategy?
We watch it very closely. I mean, I think even if you're watching it closely, though, I think there's unknown risks you have to take into account. For example, a flash crash or a rumor of a bomb at the White House or something. Even though we're watching it, we could never react fast enough to mitigate that kind of risk. So not only do we monitor all the components of the system, there's also a lot of inbuilt risk mitigation of unknown circumstances. So if I give you the example of I think it was 2013 when there was that day where they had a rumor of the White House being, I think it was being bombed or the bomb had gone off, and the ES dropped 10 points in probably 20-30 seconds, and then rallied 15 points probably 120 seconds later. In those sort of situations, we've actually got some inbuilt risk management that automatically deploys. So we have a tripwire, which if we detect a certain amount of volatility over a certain amount of time, a very short amount of time, the whole system will shut down. If we're in a position, we have the stops on the exchange, so they'll obviously get hit. But if we're not in a position, the whole system shuts down. So just in case so we don't get caught up in that kind of event. And I think the other thing probably to mention is volatility regimes. we also address the risk, the unknown risk, by having volatility regimes. So, if the environment's becoming very volatile and the market is starting to move very quickly, the system automatically recognizes this, the strategy automatically recognizes this, and will size the trades down in extreme volatility.
Okay, great. You had something, Chris?
Yeah, let me add a couple more things about monitoring the system, right? So I think that there's a lot of people out there that think you can build a system, let it run, run it while you're at work and check it at the end of the day to see if you took some trades. And, I've built a lot of software and I've seen a lot of different projects come together with a lot of different components and layers, and trading systems are just one of those things that you should not feel comfortable trading unattended. In other words, not watching it. There are just too many components to these kinds of systems. Like, even if you took the simplest case of a trading platform, say TradeStation or eSignal or Ninja, these systems have, obviously they're running applications on a Windows machine. They require an internet connection. They require a separate data feed. They require a broker and broker, servers to be able to take orders and so forth. If any one of those things fails, you could potentially be exposed in the market with no way to, and no knowledge that you're exposed in the market if one of those things goes down. It's just a massive exposure, and I think people have to be very careful with the notion that they can just let this thing trade on its own. It literally just takes one massive event, and a fund like us, we could be out of business. A personal account, if you're trading it, if it's a large account, you could lose a very sizable amount of your capital just being sort of not so smart with the way you're managing that. So yeah,
so
I just want to mention
you're continuing to be active traders even though there's a strategy that's running automatically for you. You still have to be engaged with the market day in, day out, watching what's going on. That's what you're basically saying. Okay.
Yeah, I mean, there's another element to that. So we have a sort of a real-time dashboard that monitors all our components. If one of the components goes down or if there's a failure somewhere in the chain, a huge sound alert goes on, and we can then react in whatever way is necessary.
Okay. So let's move on to money management. How is the money management determined on your strategy? Is the quantity traded always the same? Assuming there isn't money coming in and out of your fund, which you have to now start trading, in other words, increasing your size. Let's just assume that within any given day,
per trade, basically,
whatever it is you're trading, the $30 million or whatever it is that you're managing, are you changing the way you're managing the quantity based on the particular signal, or is it fixed?
So we don't trade the same size all the time, but the profit and risk targets are always the same in dollars per unit, if you like. So, for example, in the CTA, during a period of higher volatility, we half size, but then we increase the stop and the targets by 2. So I think that's probably the best way to describe it.
Gotcha.
But if I could jump in, it sounds more like you're asking, do we press our edge when we think we've got a lot of edge and sort of back off when things aren't going well?
Yeah, martingale, that sort of stuff. And
no, we don't do any of that.
Okay. For those who don't know, martingaling is basically a statistical play where essentially, and this has been kind of disproven many times, the more you take losses, the more there's a higher probability of getting into a winning streak. So the more you lose, the bigger you trade. Unfortunately, you have to have unlimited funds, and that's not a reality that we live with. And an anti-martingaling is, as you lose, you cut your size until you get to a point where you're not losing anymore, and then you revert back, which is basically what I use for my personal trading. But that's basically what I'm getting at, you know. Or, you know, do you trade bigger because your stop is closer? Do you trade smaller because your stop is farther, which is something you've answered? You know, you half your size and volatility and double your target and stop. The risk, the return and risk per trade stay the same essentially.
Correct. Yep.
How will your money management be affected when a strategy is profitable? Is there any change that occurs there?
Really no. No, the way we've designed the systems means that we don't alter sizing either during a good run or a drawdown. We believe in the system, we believe in the statistics, we believe in the back testing and the forward testing, live trading we've done. And I think, you know, in our experience, you never know when the good trades are going to show up. And again, in our experience, you know, using discretion or intervention with this system has always been a ceiling on our performance. You know, so we had a good run, we should be shutting this off, and then, you know, bang, another 3 winners, you know, come in a row. So, you know, so we're now totally hands off.
Okay. You're basically living with the statistics as the probabilities, period.
Correct.
Correct.
Okay. Trade management. What is your trade management scheme? I think you've already covered this. As we're talking, a lot of these questions become obsolete. Your target and stop distances are generally fixed, and they're immediately put on, and in some circumstances you use trailing stops, and in some circumstances you said the system recognizes that the pressure that you're trading with has dissipated, and so it changes, it basically closes the position or tightens your stops. Is that correct? Did I understand that correct?
Yeah, that's correct. I mean, we actively manage the exits and the stops, you know, depending on how the trade is going.
Okay. How long have you been trading live funds, not necessarily customer funds, but maybe your own money using this approach, just to give us a ballpark?
I think we started to gray box it back in 2013. We then, I think it was probably, this was with personal money, we had it trading automated, I'd say sort of end of 13, I think it was. Okay. But we used our own, to be honest, with you know, when you're first automating these things, it's a very steep learning curve, and you know, when you're experimenting, you have to do it with your own money. You know, you can't go around experimenting with client money. So I mean, it was really a 2-year process till we got it to a state where we were all happy enough that this was a product that could be launched.
Okay. In its current format, in the format where you said you're happy enough to launch it and put customer funds on it, as you're doing now, how often have you had to manually intervene in the strategy's operation?
I couldn't tell you how many times. It's very rare, but it does happen from time to time. And the only time we intervene if there is an issue with one of the components. There's obviously no discretion or intervention with the trades themselves. Something has to go wrong. And again, we have, you know, I was talking about it earlier, we've actually built this, you know, Chris built this, you know, fantastic dashboard that can monitor all the components all the time, and, you know, unless something goes down, we do not intervene.
Okay. Optimization, a big topic for automated trading systems. A lot of the systems that are out there, that are advertised, that are pushed onto the public, have that component in there where the results look fantastic because you can hit a button, and take your moving averages and figure out which periodicity or which look back period is optimum to create those results. Has your strategy been optimized in any way?
Yeah, this is a great question. You know, you're right, by the way. All of the tools out there right now that are sort of retail focused that allow you to do back testing make it way too easy to do optimization on your inputs and even your outputs. And you know, I would say I really hate the word optimization because it sort of means you're looking for the ideal. You're looking for the perfect, you know, fit to what you're working on. the perfect set of circumstances, and it's really not what you're trying to do with the trading system. Trading system, you know, you're not trying. You're trying to do something more general, and you're not trying to do something optimally. You want the system to work generally well across a variety of inputs, not perfectly. You know, this is one of the keys. You know, why those results and those equity curves look so good is because they're basically fitting the data. They're curve fitting the system.
So that begs the question. With your system essentially using real-time data on the underlying market,
yes,
is it optimizable?
So, well, that's a great question. I mean, you can go back and look at historical data, and we have done that. But with our system, I like to say we've sort of generalized it. We have not optimized it at all in the traditional sense, where you're looking at a matrix of input values and then trying to figure out what gave me the best P&L or the best profit factor or the best win rate or whatever metric you want to use. We haven't done that.
Okay.
But we have generalized the system in such a way that it works generally well. Doesn't work excellent on every single piece of data we've seen, and that's really what you need to be focused on. It's hard to do, very hard to do.
Okay. So in what way can a developer be sure that this strategy will perform live as it did hypothetically? I mean, if you take your test results, you penalize them by a tick for entry, tick for exit, and whatever other factors you can identify. What is required what did it require of you to say, look, our back testing data we have a high confidence in it that the hypotheticals we have will reflect the live performance once it is live?
Yeah. I mean, at the end of the day, you can never be sure how it's going to perform live, which is why we always like to forward trade our newer signals for a period of time. And that just means, you know, you're giving it new market data and simulating it trading in a sim account or with small size. It really comes down to the process you followed in building the signal. If your process was signal development process was done correctly, and there are a ton of pitfalls, and I can mention a bunch of those, but if you've done the process correctly, it should fall within the historical sort of statistics that you've seen during your testing. You know, if it doesn't perform well in live testing, you know, it'll go one of two ways, right? One way would be it diverges rapidly and raises big red flags all over the place, in which case you have a huge problem on your hand, and it's mostly that there's something very wrong with your process. Or somewhat even worse, it might diverge slowly over time, and those kind of signals are very hard to detect that, you know, they're not working well, and it can be very costly to wait to find out that a signal is not really performing well. That slow divergence.
Because you have to balance, okay, is the system not working? In other words, is this an issue of this not having an edge, or are the market conditions such that they're not favorable, which means I need to give it more time, which means I need to lose more money to figure out that something's really wrong.
It's very painful, and if you think, you know, system trading doesn't have emotions involved, go through a slow degrading signal and drawdown and see how you feel. It's much like, you know, trading in a drawdown as a discretionary trader.
Okay, that pretty much answers. Go ahead.
Yeah, I just was going to say it makes you question everything.
Yeah, as trading manually does every day.
Yeah.
Okay. So let's shift gears here, and I know we're kind of pushing a lot of data, pulling a lot of data out of you, but we're almost there. Strategy coding development. What was your process like to define the inputs? So you've got this idea. How do you kind of put it in a way that then becomes a signal that can be coded?
Right. I mean, this is the crux of it all, right? So if somebody was going to start out and say, I want to develop a system and build a system, this is the crux of it all, right? You know, for us, our signals really start within the context of market structure. You know, the way price action behaves, the mechanisms that move price, and things like that. We obviously see, you know, different repeatable patterns. They may not be, you know, candlestick patterns, but there are different sort of themes that move price. I mean, you know, Morad, when you do your trader bites, you talk about low volume nodes and the normal process of the auction. I mean, these are things that are predictable market structures. You know, we don't use volume profile, but it's a good example of what I mean by core market structure. So we're looking to model with our signals some well-defined pattern that we have seen personally ourselves. We're not out there trying to, you know, mine raw price data for some kind of price patterns. We very much so start with market structure and we move from there.
Yeah, I would say that that's probably a key element of creating a system, is not to kind of do the mathematical PhD thing and going out there and just running a bunch of tests on data, but rather to have a market concept and then make the effort at coding it, which is difficult to do. I've been involved in that process, and it's really hard to kind of. There's a lot more stuff that happens when we click manually that we don't think about, that when you try to code is very, very complex sometimes.
Very complex.
But that's a very good point, that whatever system you're creating or trading needs to be built on some on a sound concept that is market-based rather than data-driven, right?
I mean, I know there are people out there that are building systems, and some of them are quite successful, and they're just looking at raw data, and they're able to tease out some systems that seem to work, you know, over some period of time. But I see a lot of developers. I mean, I'm a longtime technical guy myself, and I see a lot of developers just taking raw price data and using new, you know, frameworks or tools out there, some machine learning and statistical tools, but they're really not grounded in. You got to be very careful. They're really not grounded in any kind of market structure, and that's just a difficult bridge to gap. And it's, you know, I hate to see when I see that, I hate to see it, but I see it all over the place, unfortunately.
Okay.
I want to say one other thing about our signals is we do spend a fair amount of time statistically modeling behaviors as well, and so this is where the quantitative part comes in for us. You know, we've got a very large set of proprietary data that we have collected from the market over a number of years, and, you know, quantifying that data to say this is more likely to happen when these circumstances are present is one of the key inputs to our signals. You know, so one example would be, you know, we're talking about buying and selling pressure. If we notice that the price of the ES is going up and there's absolutely no buying pressure, sort of a classic divergence, and we know how to quantify buying pressure from our market scanning, this is a good example of sort of how we look at the world. That's a good input for us to our signals, and that helps us get a little edge out of our signals. You know, I know you use Delta quite a bit. It's similar but different.
Okay. How did you go about coding your system? Did you do it yourself? I know you have a computer science background and Microsoft and all that. Did you do it yourself, or did you pay someone to convert your signals into an automated strategy and do all the back testing and stuff?
Yeah, it's a good one. You know, we have a couple developers that we're working with. Hamad Khan is one of them, and we've got one other that have really done everything from our real-time market scanning software to our signal generator to our backtest system, to our order execution and our dashboards and all that kind of stuff, is really all built custom by a handful of developers.
Okay. So that brings us to the question, what software are you using to do the development?
Right. So our core trading platform is, it runs on a Linux server. It's web-based. We've got a pretty nice web-based operations and management console. It's built in a combination of PHP, MySQL, and some C++ and C#. These are just kind of the tools that sort of met our requirements and that we knew. But certainly you could build the same type of thing we've built in a bunch of different languages, like you're mentioning here, Java, Python, C++, and so forth.
So the core engine that's generating, scanning for the signal, sending the signal through to execution and so forth, that's also built on PHP, MySQL, C++, and C#, or is it?
Correct, yes.
Okay. How often do you have to tweak or update your strategy?
Right. So the strategy itself is fixed. We don't tweak it. But that said, we have, one of the things, if you're going to be a system trader, you really need to have a healthy pipeline of ideas, a big list of, new signal ideas to try. And so most of the work we do on the development side is sort of evolving our platform just so we can try out some new ideas.
And by that, the ideas could be as simple as, hey, this is doing great on the ES, or actually the performance is degrading on the ES, let's look at the NASDAQ, let's look at the DAX. It's not necessarily that the signal itself changes. Your exploration, the pipeline includes looking at other products. Am I correct?
Yeah, that's right. That's right. But it might be something so simple as saying, I want to use a dynamic trailing stop instead of a normal trailing stop. And trailing stops are things we've built and manage on our servers. We don't, push those out and rest those on the exchange.
Mm-hmm.
So, there are things like that. Maybe we want a little bit of a different behavior around our trailing stop than is, sort of baked into a trailing stop order type you might find at one of the brokers.
Okay. Now this is kind of a loaded question. I know it varies a lot based on complexity and requirements, but if I had a trading idea, let's just say it's simple enough that you can write it on the back of a napkin, what should I expect to pay to have that coded properly?
It is a tough one. If you've written it on a napkin, I know people like simple systems, and one of the things I've found is that simple systems never start out simple. You sort of have to make mistakes. You have to build out a full system and wind up whittling it down to something that's really a polished gem. And getting a simple system just is a process. So if you've got something on a napkin that's a simple system, hopefully you've spent a lot of time thinking about it. But in general, you kind of get what you pay for. If you're going to go out and hire somebody off the street on Elance or somewhere to do some contract development to build out your signal, that's fine. You will get what you pay for. Very early on, as you're building out a signal, you're going to have a ton of changes and things you want to try, and the process of getting to something that's tradable, it can be long and drawn out. You might not have an edge in your signal until you make a bunch more changes. So it can be costly and it can take a lot of time. The other thing is, again, I found that working with developers that have limited financial market experience can be quite difficult.
Yeah, because then you have to explain what an offer is,
right?
and a bid, and what a stop and a trailing stop is. So you have to kind of you have to spend a lot of time educating them on the market itself before you can actually talk about specifics in the system. Is that why you're saying that?
Yeah, I mean, there are so many nuances, small things that might be inconsequential to somebody without financial market experience that might be major deal breakers. And so, you know, I can't think of a good example right now, but I've just found it more difficult. So if you can find someone who's a developer who has real market experience, and these people are in very high demand, you should contract them immediately if you've got a signal idea that you're serious about building out. I honestly would expect to pay, you know, in the $80 to $150 an hour range.
Okay.
This is not cheap.
Yeah.
And by the way, let me say one more thing really quick. I got to put a quick plug in here. We are looking for another developer ourselves. If you are a trader or a developer,
you're using our audience to solicit for employment.
quick plug. If you are a developer or a trader, and you want to make you want to be involved in something really interesting, unique, and very cool, definitely contact me.
All right. If you're interested in working with Chris and Adam and Red Ivy Advisors, just shoot us a message. You can get a hold of me at info@futurestrader71.com or on the website futurestrader71.com/contact, and I'll put you in contact with these guys.
Thank you for that shameless.
So on the side note, so we know it takes $80 to $150 an hour to pay someone to code our system. Now we need that system to be able to talk to our broker, our brokerage connection, which is a whole different component of the system. In general, if you're writing to an API, be it a CQG, GAIN, or whatever, we support. Stage 5 supports all of those. What should we expect the cost there to be able to take it and have it send the signals live into the market through some sort of an API connection? What does that cost?
Right. You know, I mean, let's be clear. There are a lot of popular trading platforms out there that you build and trade strategies out of the box. You know, TradeStation, eSignal, Ninja, AmiBroker. I mean, there's a whole bunch of them. But you know, there are some issues with pretty much every single one of them in different cases. But as you pointed out, you know, we built our own execution software connection. And it's really given us a lot more control and a lot of options. But you know, to answer your question, it probably costs us, I think, for the first broker connection that we made, it was probably about 3 months worth of development time. And again, this is some pretty hardcore code that needed to be written, managing orders back and forth, and it's a pretty serious piece of code. About 3 months for the first one, and then you know they've become easier over time as we've added additional ones and less expensive to do as we've added more to the platform. So.
Okay. Last question here in this spree. What type of server are you running your signals off of?
Right. So again, I would say, generally speaking, every different strategy is going to have different requirements. You know, but each one of our deployments uses 2 servers, and we've got 10 servers in total to trade all of our different signals in the different markets we're in. Our servers are pretty standard. I mean, they're quad-core CPUs with 16 gig of RAM. Nothing
Linux-based,
outlandish.
you said?
Yeah, Linux.
Okay, so they're on the cloud somewhere?
Yeah, so we use Microsoft's Azure platform. We found that, you know, and you can get a server hosted at any of the big tech companies. I think unless your strategy is very latency specific or requires very low latency. You know, this idea of co-locating at the exchange it's really not something you need to do. I mean, we're intraday traders, but we're not looking at milliseconds. We might trade, I don't know, between 2 and 5 or 6 times a day, something like that. And so latency is not that important. But Microsoft's Azure platform lets us, spin up servers in different data centers. So we've got servers in Amsterdam and Chicago and New York, and it really gets us close to the market centers we're trading. You can go and try to trade using TradeStation off your laptop at home, but again, I'll give my spiel about risk and the risk of a power outage, the risk of an internet outage, or using a low-cost server hosting provider and the risk of a server outage there. You just definitely get what you pay for. You just cannot risk your hard-earned capital by skimping on this kind of stuff.
Yeah, these servers are not that expensive anyway. I mean, you're looking at probably at most a couple of $100 a month or something to rent.
Correct, yeah. And Microsoft, Google, Amazon, they all have great hosting platforms. Any one of those is just fine.
Very cool. So we're going to shift gears here for a minute. Anthony from Stage 5 wanted to make this announcement. Most of you know Anthony is the managing partner at Stage 5 Trading. He's the lead broker of the cutting-edge brokerage that I'm involved in. The contact information is right there in case you have questions about this announcement. But what's happened over the last few months is that we've worked with Red Ivy to take some signals, components of their signals, and make them available to our traders. So we've named the system Red Ivy Alchemy ES. The thing that's significant about this strategy is that it has a low barrier to entry. Per unit, the suggested account balance is $15,000, whereas a CTA requires on the low end 50 to 100,000 minimum per unit. Usually to participate in a CTA you need about 250,000 or more. The Alchemy strategy, which is built on what Chris and Adam have been talking about all along, and this is only for those who are interested in this sort of thing. It trades 2 ES contracts per unit, all in, all out, intraday only. It trades approximately 2 to 4 times per day, depending on volatility. More when there's more volatility, and there's all the costs. There's information online. I'll give you the website for it. All costs associated with the program are included in the fees that is required by regulations. There's no subscription fee. Most of the time we've worked with trading systems in the past, and there's usually a subscription fee that has to be paid to the developer. There's no subscription fee for this. If you're interested, here's the website. This is the web page. You can just go to stage5trading.com/Red Ivy and fill out the form. Please take a moment to read the disclosures in here and to look at this performance at your own pace, but please make sure you read the hypothetical disclosures. The system is fairly new, and I think it's very interesting in my opinion. I've gone through the trades myself before we decided to deploy it at Stage 5. And look through it. It doesn't mean that the results are going to be fantastic or whatever. Past performance is not indicative of future results as always, but I think it's very promising. That's just my opinion. If you want more information, just fill out the form. I'll give you the URL in a minute. This is more, we'll go over who this is for. The program is available immediately because we don't want the performance to degrade. We're limiting the number of units that can be traded to 300 before it's closed. And when it's closed, it could reopen again as people move in and out of the out of the system, out of the strategy. Any one participant can allocate more than one unit. You can trade more than one unit depending on what your risk appetite is and what your account balance is. And once the program's full, you may still participate if someone leaves and gives up a spot. Who is this ideal for? In our opinion, this is ideal for someone who has trading experience, because again, the numbers that come out of this program are not investment numbers. We're not looking at 3-to-1 profit factors and things like that. This program trades like a trader, in my opinion, and it's a trading strategy. It's not an investment program. So this is meant for people who have trading experience. The ideal candidate is also a professional who may not get as much time in front of the market. They're just not able to participate in the market as they would like. Someone who likes to see market activity on a daily basis in the futures, and someone who's looking to diversify the outcome of their own trading. And here's the website. Just go to stage5trading.com/redivy to get all the information you need on this. Again, all costs are reflected in the performance shown. Back to business. So we want to attack this from the perspective of what should listeners know about auto trading. We want to summarize what listeners should know. Just some general knowledge questions. We have about 15 minutes left here. What do you believe makes a usable or robust strategy? I think you might have answered that a little bit earlier. In a few words, what do you guys think would make a usable or robust strategy?
I think to define a strategy as robust, the underlying philosophy, if you like, the underlying core signals, should be applicable to different markets, different products. I mean, you may need to account for some subtle structural differences, like, for example, Japan closes at lunchtime, but I think if the core signals can work in different markets, it's a pretty good sign that it's fairly robust.
Okay. Are there ways to tell? Are there ways to tell if a signal is robust, strategy is robust or not? In other words, how much maybe back testing needs to be done? How big a duration of back testing, look back period, needs to be used? Maybe what would be your criteria for that? Or are there other ways to determine whether a strategy is robust before deploying it?
Yeah, I mean, I think you've got to, it's obviously it's got to have this, positive expectancy or alpha generation. But I think you've also got to know how someone got there, with a back test or whatever it may be, or just a short, a short period of live trading. If someone's been using 25 parameters and optimizing the hell out of them, it's not very robust. The less parameters, it's suggesting it's going to be a more robust system. Are they testing it on multiple markets? When they're building out the signal, you want to test it on different markets. See if, because if it works on different markets, there's a much better chance that future adaptations in the market are still going to leave you with a system that works.
Okay.
What else is there? I mean, I think another one is. Yeah, I was going to say, I think how often the system trades is another one. If a system trades once a month, unless you've got 50 years of data, it's probably, it's tough to say it's a robust system. To be statistically significant, you need
to have a minimum sample of trades. It's more so than time, wouldn't you say? I mean, it's great. Trades, yeah, you might have 15 years of back testing data, but if it's a once a year signal and your sample size is 15, I would say that statistically speaking, that would be a low confidence level in the probability outcome. So you need not only time, but you need a high sample. Do you have just based on your experience or research, what that sample size, minimum sample size ought to be? How does a person who's working on a system on their own, many of our viewers are watching this for that reason, how would one determine whether or not they have enough of a sample size?
I mean, I think it's it's obviously an individual thing, but for us, we look for around 300 as a minimum.
300.
Yeah, I mean, I can jump in here. It really comes down to the type of system. If it's an intraday system and you've got 300 to 500 trades in a year, you're probably doing okay. You're probably okay on the statistically significant side. If you're coming up with 50 trades a year or 30 trades a year, you're in real trouble. Consequently, if it's and it comes down to how many years of data also do you need to see, depending on the type of system. So if it's on a swing system, and the swing system, let's say it's a trend following system and it trades 2 or 3 times a year, those might be fantastic systems with huge outsized asymmetric risk-reward ratios, but they're very difficult to have a lot of confidence in just on the the pure number of trades you're seeing, the instances of trades, I think is kind of what you're getting at.
Right. Okay. Okay. Excellent.
More
general.
Before you go, I got one. I want one other one that we've is fixed values. Very difficult to have systems transferring from different markets. If you have fixed point stops, for example, that's another I'd say red flag.
Okay. Yeah, I mean a 12-tick stop in ES is a whole different ball of wax versus 12-tick stop in gold or crude oil or something else, DAX maybe. You're going to get triggered on that much more often, so you have to compensate for it.
But also, let's say you're testing a system from 2009. The market was half what it is now. If you have a 4-point stop in 2009, it's really now an 8-point stop. So unless you adjust, it's another thing to look at.
What areas have you seen or are aware of where strategy developers fail or come up short? Again, you've answered this, kind of trickled your answer across this presentation so far. Can you think of anything else where developers kind of fall flat on their face, or you may have fallen flat on your face at the beginning, things that you now figured that you shouldn't be doing?
Absolutely. So I think idea generation, I think I talked about that, is just key. The process that you follow to define your signals is key. There's so many pitfalls where and we've hit every single one of them head on at one point in our journey. Anything from data issues, making sure that you've got good, clean data, complete data. If you go out and try to use TradeStation and look for historical components of the S&P 500, you will very quickly realize that Enron is nowhere to be found, and that's a major issue. WorldCom is nowhere to be found. It's a major issue, but most people don't think about it, or they don't realize it, and it's a pitfall. It means your results are suspect. Another one with data is data that's poorly manipulated. So in the futures world, you really have to know how is your continuous contract, how are rollovers handled, in other words, in your continuous contract. That's very important stuff. In terms of data mining, there's a ton of different issues with that. Data snooping, curve fitting, we talked about. Back test process, we talked about over-optimizing. There's in sample, out of sample data misuse. I see this all the time. Somebody will go and back test a bunch of signals with some in sample data. They'll test it with out of sample. They're not happy with the results. They'll go back to in sample, and all of a sudden you've got everything is in sample. It's just such an easy thing to do with the tools that we have. But you have to be very definite about how you're going to use the tools and how you're going to avoid some of these pitfalls. Cross-validation, Monte Carlo. Not enough people, I think, do Monte Carlo simulations on their backtest performance. This is a way of introducing some randomness and getting a distribution of results versus one result with a backtest. So important to do that.
I think you just got a whole bunch of system traders to perk up with using those
right.
using those
I
terms.
mean, literally, you could write a book. I'm sure books have been written on all these pitfalls. I haven't seen one in one place, but if somebody has one, they should put it out there so people are aware of it. It's just too easy to fall into one of these traps. Here's the thing. If you make a mistake in any one of these areas, your results are suspect. And you know, in essence, what I'm saying is you need to master all of these areas in order to come out with a decent, robust system that you can trust on the back end.
Okay.
That's really what it comes down to.
Cool. What benefits are there for trading through a strategy? Sounds like a lot of work.
Yeah, I mean, it is a lot of work. I think we covered a lot of these. Yeah, you
have.
It's very efficient. You know, once you do get a system going, you can keep adding signals. You know, compared to discretionary trading, it's incredibly efficient. You know, the discipline is enforced. There's no emotion. I think once you've put the time in, you know, the time up front, can pay dividends down the road as you roll it out into different, you know, multiple markets and products, etc.
Okay. I think you've covered the drawbacks also a little bit on with strategy trading. Do you want to summarize those again?
I think the drawbacks, I think for most people, it's not necessarily a drawback, but I think you've got to honor the system. It needs patience, and I think that's even harder when it's not when a strategy is not fully automated. It's, you know, it can be disheartening when you head into a drawdown and you actually wonder whether, you know, the system is going to, you know, it feels at that point like it's never going to work again. But I think if if you've done the work and you've done it correctly and you stick to your guns, as long as it's operating within the parameters of the back test or your sort of forward trading, then, you know, you should be okay. So
I would imagine
the hardest part.
If your system's going through a drawdown, as you know, your fund has probably gone through a drawdown period, as every fund has gone through a drawdown period, it's to be expected. I would imagine it's with a system, you can't just turn it off. You have to keep taking the next signal and kind of living with the statistics. And I imagine that is very, very difficult for someone who's in control and can turn the thing off, as opposed to someone who's investing in a system and is confident in its developers. I would see that as a major drawback, and I think many people who have invested in systems see that as a difficult thing to deal with, and that you're having to continue to participate. And as a manual or a discretionary trader, that's what you're supposed to do. You're supposed to continue to, as long as the market did not change enough to eliminate your edge, you have to keep participating, because you don't know where the distribution of the winners versus the losers is. The winner may come right after you turn the system off, and the winner may not come for another 20 trades while your system is running, you know. So I would imagine that that's a very difficult thing, and I think that's one of the things we have to deal with, especially with this alchemy program, that we have to manage people's expectations. We'll talk about that in a second. Infrastructure-wise, understanding that you're running a fund, what is the best infrastructure for an individual to run his or her own strategy? I think you answered that already by saying just get a server.
Yeah.
Okay, so
yeah,
we've gone.
I would definitely get a server. Yeah.
Okay, market conditions. What market conditions have produced the best results for your trading signals?
Our strategy tends to do well in a variety of conditions. That was, very much part of the design process. But obviously, no strategy works in every situation, every market. But we tend to do well when the days start to have or display larger than normal intraday swings.
Okay.
So a little bit of volatility, but then not too much volatility.
Too crazy.
Not too crazy.
And then would you say then the next question, what market conditions would be unfavorable for your trading strategy? On the one hand, you want volatility, but not too much. How about very little volatility? How does that work for your system?
Yeah, I mean, that's probably, if we have to say we have, there is, the weak spot for us is probably low range days, where you've got low volatility or there's just generally you get low institutional participation. It kind of makes sense because what we're doing and the whole philosophy behind our algo is that we're looking for institutional buying and selling, and so on a low volume range day, those guys aren't there, and so it's either hard for us to get the signals, and we just sit here twiddling our thumbs, or it may be that you get a few false starts where it starts to display looks like a good setup, but because of that there's no real institutional participation, it quickly fades away.
And we saw that in May, didn't we? We saw May where it just kind of grinds up in these very tiny range days. And would you consider May to be kind of an unfavorable environment for most of the month? Would you agree with that?
Yeah. No, but especially a large period of contraction with the VIX, heading towards the low, multi, sort of back at those sort of multi-year low levels, is a sort of a setup where we will struggle a little bit. But then if you look at what happened in June, a little bit of volatility shows up, and as long as we can, I guess, defend those periods, as soon as the market kind of perks up and starts to give us some movement, the idea is that we can then exploit that to the full.
Okay. For those who are considering, so we're going to talk about expectations a little bit here. For those who are considering putting their money in an automated trading strategy, what would be your advice to get them prepared to trade it? What would be your, what sorts of things would you want to offer someone who's maybe coming into your fund to manage their expectations as they start to trade this strategy? What should they?
Yeah, I mean, I'd say to understand the product, first of all, do your homework, make sure you understand, the leverage in the system, the size, the size of gains and losses. Make sure that leverage is appropriate for your risk tolerance. Some people are happy with a 5% drawdown. Other people can take a 20% drawdown. A system that draws down 20% may return much higher. But as long as you spend some time studying the system, and then once you've studied the system and you're happy with the sort of the parameters that the system displays, I think then you can then, I guess, manage your expectations going forwards. If there is a drawdown, you kind of you know what it is expected to be, so you've kind of pre-prepared yourself to have some patience during those sort of periods, and then also and then also on the upside, you understand. Hopefully the sort of range that the system can operate in, what sort of returns you'll get over the years. So I'd say it's kind of really just doing the homework and making sure it's appropriate for you.
Okay. So with that being said, the next question is, what do you believe challenges clients who are trading your strategy? You've been trading the strategy live for some time. Would you then say that one of the things you have to kind of battle with all the time is the drawdown period is exactly that period where someone trading the strategy would want to leave, and that's basically the worst time to leave. How often do you have to deal with that expectation that you're kind of trying to help someone stay, not because you want them to continue to trade your strategy, but because generally, in my experience at least, people want to leave when it really is at its worst, essentially. What challenges do clients run into, first of all, when trading a strategy such as yours?
I mean, I think that's it. I think it's it's during the drawdown, even though the system will be performing within the historical statistical parameters, they still don't like the drawdown and they may want to leave. Then our advice to them is this is within expectations. The daily loss and daily gains you're seeing are within expectations. If you've prepared yourself correctly and you've looked at the numbers, the idea is that hopefully that's not a problem for you. But some people nevertheless will. The system may have a max drawdown of 10, 11% or whatever, but you'll still have people at 5% or 4% going, what the hell's going on? I can't take this. I want to get out. And it's difficult. You can only reply with what you know and what we understand.
Right. Okay. And then just a couple more questions here. Assuming the strategy is robust and has an edge, in your professional opinion, how long should a person stick with a trading strategy in order to have a chance at seeing that edge appear in the form of positive returns?
I think we kind of answered that. As long as it's performing within the historical parameters, I think is one thing. You've got to give it time to trade enough entries so that you can objectively judge whether the strategy is working. So I think give it enough time, and I think this kind of goes back again to the sizing issue. If you've sized correctly, you should be comfortable with a certain drawdown and being able to give it time to work.
Mm-hmm. Well, I mean, I've been watching the strategy that you've allocated to stage 5. I've been watching it live. In fact, I have the TA results. Again, past performance is not indicative of future results. This is live. These are the TA results for the trades that it took today. You can see the MFE, MAE is very, very good. It did well today. That doesn't mean it'll do well tomorrow. We've been trading this strategy live, or S5 has been trading this strategy live since the beginning of May. We ended up with a drawdown by the end of May, but nothing dramatic. And as it stands right now, and I'm not sure if I can show this or not, but I guess maybe I'll err on the side of being compliant. But as of right now, the program has made a pretty decent return even after the drawdowns, recovered the drawdown, and put on more gains since the beginning of May. Again, that doesn't represent your experience of what will happen going forward, but we are watching this thing trade live, and I am tracking it using the trade analyzer just to see how it's performing. And it's interesting because it performs in general. It is really, because we're using it as a trading program as opposed to an investment strategy, because of the leverage that's in it. We're looking at it as an intraday product. It looks a lot like a day trader, and that's to be expected, I guess. Monitoring performance, you said that you monitor performance very closely. If you put your money in someone's trading strategy, how closely should you monitor its performance?
I think you should monitor it pretty closely. You've got to look for situations outside of what is expected. So if you've looked at daily returns, if you start to see outsized days that are out of what you expect, or outsized weeks on the upside as well as the down, you've got to pay attention to that. But I think overall, you've got to keep an eye on it, but at the same time, you kind of got to let it play out. Obviously, in our nature, that you get more nervous as as it enter a drawdown, but and the motivation to pull during a drawdown is high. But I think as long as it's performing within the historical characteristics, a little bit of patience is kind of the key.
Okay. Pitfalls. I think we've covered these pretty thoroughly. The pitfalls that traders should consider before trading in a strategy, and that includes trading the strategy itself. In other words, trying to time the strategy would be one that we've experienced through various trading systems. People come in, the system gets into a drawdown, they pull out, and then as soon as they pull out, in my experience, the system kind of gets back into the swing of things and so on. The strategies fall in and out of favor with the market. The market operates in cycles. Can you identify other pitfalls that you've seen automated traders fall into when they start participating in an automated strategy, whether it's their own or someone else's?
I think I think before you enter the strategy is probably where you should do more of your work. If you start to see some red flags, like the equity curve looks too good, the win rate's like 75%, or it's got a Sharpe ratio of 5, or some huge long-term profit factor. There are systems that have these amazing statistics, but they're kind of, they're elite systems. There's very few of them out there. And one particular one that I was watching actually had, was pretty much, it looked incredible on paper, but he was selling, the whole system was based on selling out of the money premium on sort of it looks great for 2 or 3 years, and then you hit like August last year, where you had this massive explosion of volatility, and
give it all back.
You just wiped out. So it's kind of looking if it's too good to be true, and then trying to understand what are the guys trading, how are they trading it, and kind of is there some inherent risk behind these great numbers that you're not really considering.
Right. Okay, so just to move us along, that's pretty much it. The questions that came across, most of them were answered as we're going along. One of the questions that was asked is, does your strategy trade more than one instrument? Does it or does it not?
We trade more than one market, so we're trading, we're trading different futures contracts in Japan, Germany, and the US. But no, we don't trade sort of gold or metals, for example, with the same strategy.
Okay.
But let me add to that. It's that those are products we trade inside the CTA,
Yeah.
but for the purpose of the program, we trade just the ES, and in the CTA we trade one contract market at a time. We don't intermix and have positions on the DAX and the ES at the same time, for instance.
Okay.
And the idea with the CTA is that it trades one pool of money, trades 18 hours a day on an intraday basis. So it trades Europe, then it moves to the US, then as we close out the position in the US, we then move to Asia in the evening.
Yeah, so the Red Ivy Alchemy strategy that's available at stage 5, that's an ES only strategy, just
Correct.
to be clear. Hopefully down the line, as you gentlemen develop more instruments, products to trade, then we would be looking at including those. But for now, it's really an ES only. Do you see a lasting edge for manual traders in the future? Do you think that a manual or discretionary trader can have an edge, a long-term edge, with all these systems being traded?
I mean, I think so. Yeah. I mean, it's everyone's different, and I'm sure there's people who develop trading strategies that are very robust and are totally discretionary. I can't see why not, but I think it's getting with all the algos and with the high frequency guys on the tape, making it very difficult to watch. I think it's a lot more difficult than it used to be, especially on the shorter time frames, I would say.
Okay.
I would add that the guys I see that are doing well are the guys that are almost acting like algorithmic traders. They've got 1 or 2 or 3 setups. They trade them religiously. They don't deviate. They've got excellent discipline and excellent emotional control. Those guys are going to do fine. And then on the other side is, as you elongate your time frame, I think there's a lot of room for discretionary traders there. It's just the shorter term time frames I think have gotten more difficult.
Yeah, and that's a point of debate there. The fact that Morgan Stanley can come out and write on the Financial Times that 84% or some such statistic, I don't remember exactly, that the volume going across the exchange, the equities exchanges, is algorithmic or computer based. I tend to take issue with that. In that, yes, it is identified. Like, for example, if you're trading on the ES to the CME, you have to identify that the program, that the entry system is computer-based. Now, you could be sitting there saying, buy 10,000 contracts ES at 2070, but those are identified as algorithmic or computer-based trades because they're generated by a computer. So I think that statistic is very deceptive because a fund may look at fundamentals and may decide based on Fed fund projections that the Fed is not going to raise rates for the rest of the year and therefore it wants to buy. It doesn't go out there and fund manager is not going to log in and execute 100,000 contracts by sitting there and clicking on the mouse all day long. They just put it through an algo, and that algo, it has to be identified using what's called a tag 50 as a computer, and those are monitored separately by the CME because those are the types of systems that create the flash crash type of thing, and those are executed algorithmically and therefore are registered as computer trades. I think though people confuse that with systems that absolutely and autonomously generate a signal and trade it like you have. So I just wanted to kind of make that point a little bit selfishly because I am a discretionary trader, and I feel like as long as it's exactly right, as long as your time frame is not fighting in the millisecond range, it really is a market that's driven by sentiment, which is generated by people rather than
Yes.
systems. Someone's asking, just on a side note, someone's asking about your CTA and its performance. I want to make it clear that the CTA is for qualified investors only, QEPs, and that's why you don't see, if you look up Red Ivy Advisors, you don't see their performance out there, but you can contact them through the link on their site to get that information from them if you wish. Other questions that have been put out there, I think we've hit pretty much what steps should a retail trader take to move towards becoming automated. I think the answer to that is intertwined in the presentation itself. Would you repeat this process today knowing what you know? Would you go through this again, the process of kind of programming and developing a strategy and monitoring it and all that stuff? How would that decision be immediate, and would you say, oh, heck yeah? Or would it be a more hesitant decision where you're thinking, well, if this, and this, under these conditions, I would again? What would be your response to that?
So for me, again, Adam can answer for himself, but for me, it would be an emphatic yes, absolutely. You know, this is the kind of you know, activity that doesn't feel like a job. It feels more like, you know, a very interesting area, very satisfying place to, you know, exercise your intellectual capital. And I would absolutely do it again in a heartbeat. There would be some things I would change on the approach, and maybe you get to further along in the journey a little faster, but emphatically, yes.
Okay, very cool. One last question by Margaret. Are you concerned about hackers hacking into your servers since they are cloud-based?
No, it's a great question. Not, I mean, we're very, very careful. We're very security-minded. There's really nothing that a hacker could do other than basically, you know, interrupt our operations. But we're watching every system component, and we're watching the access to all of our servers in real time every day. We're keenly aware of every IP address that logs in and is able to get access to our servers. So are we worried about it?
For you is a denial of service attack, maybe finding out what your IP address is for the server and bombarding it with requests that it cannot actually operate. That would be pretty much the risk there, right?
Right, and some of that's mitigated by, you know, the Microsoft Azure platform itself. You know, they will rotate IP addresses and do some interesting stuff to keep denial of service attacks at bay. But we're aware of it. We're watching it. We're concerned about it, but we're not, you know, so concerned that we would change what we're doing or do that differently.
Okay. Very cool. I think our time is up. It's 5:02 p.m. Chicago time, 6:02 Eastern. Out of respect for everyone's time, I want to make sure that we wrap up. I want to thank you emphatically for joining us. This has been a huge topic. We've debated a lot in the S5 chat room and across different channels. And now we have kind of the horse's mouth telling us what it takes, and it seems like it's a lot of work, as is trading in general. You have to keep developing your edge and so on. So I want to just thank you for taking the afternoon to be with us. For those of you who are, again, interested in participating in this is not for everybody. This is for traders, and I don't want to sound like I'm plugging a system, but if you're interested in participating in this, you have the information. And if you need to get a hold of Adam or Chris, just I see a couple of you have written about the employment offer as they're looking for coders. I'll forward those to them. And you can communicate with them directly. Anyway, I want to thank you guys for showing up, for being open with what you're doing, and for helping us understand how these automated systems are put together and what to look out for. Thanks, guys, for coming on.
Thanks for having us, Morad.
Thanks very much.
Take care. Good night, everyone.